The foreign exchange market is where investors, banks, businesses, and governments buy and sell world currencies. Also called the Forex market, it is by far the largest, most liquid market in the world, with roughly $4 trillion changing hands every day. But it wasn't always that way. Between 1944 and 1971, the value of the world's currencies were all pegged to the United States dollar. It was a way of stabilizing the world's economy, which was highly volatile following World War II. But as the years went on, countries grew tired of this system. After all, the US dollar was pegged to the price of gold, so every time gold rose in value, inflation would spread far and wide. That is, until 1971, when US President Richard Nixon eliminated the gold standard for the US, effectively severing the connection between the US dollar and international currencies. This new, free-floating environment, in which the value of currencies fluctuated based on market conditions, soon gave rise to the modern currency exchange market. Unlike the stock market, Forex trading is an over-the-counter market and is not conducted in a physical location. There are two types of Forex trading. Institutional, which runs the interbank market and consists mostly of large banks, and exchange-based trading, which is more open and has recently spawned web-based trading platforms that allow anyone to get involved. Like consumers who want to buy goods from a foreign country, or travelers looking for the best exchange rate, or businesses who are conducting trade abroad. And of course, investors and speculators who wish to benefit from movements in the Forex markets. For these investors, trading on the Forex market offers several advantages. First, it's open 24 hours a day, 5 days a week, with the greatest liquidity occurring when the business hours in multiple time zones overlap. Second, it's relatively cheap, thanks to tighter spreads as compared to other securities like stocks. Third, because of margin-based trading, there's a greater potential to see high returns in a short amount of time. And finally, through short sales, you can profit regardless of the direction of the overall market. But, of course, trading in the Forex market doesn't come without risk. That's why you should never trade with money that you can't afford to lose. And you should always deal with reputable brokers who are in good standing with a recognized regulator. So, those are the basics. Next, let's look at what you need to know before jumping into the Forex market yourself. Ready to make your first trade in Forex? First thing you should do is open a practice account. Why? Because they allow you to hone your skills with virtual cash, so you don't have to risk your hard-earned money. Once you feel comfortable with your trading skills, you'll then want to create a watch list of currencies you intend to trade and learn the factors that affect their value. Then figure out which kind of trades you want to make. Intraday trades, also known as day trades, are opened and closed within the same trading day. These are good for beginners, as they allow you to keep a close eye on your profits and losses. Then there are intraday trades, which are held open overnight and remain in effect the following day. You'd make an intraday trade if you expected a currency to increase in value over time, or if you were conducting a carry trade, in which you buy higher yielding currency and eventually sell lower yielding currency in an attempt to profit off the difference in interest rates. Either way, you'll need to do your research. Most Forex traders are divided into two groups: those who focus on a currency's technicals and those who focus on their fundamentals. Technicals refer to the raw data, the charts and graphs that help traders identify potential buy and sell levels. The fundamentals refer to the news events and overall economic climate that will help determine where the currency's exchange rates are headed. Once you have found the trade you like, it's time to place a Forex order. Most brokers offer several order types, like market orders. These are executed immediately at the current market price. Limit orders, which are basically buy or sell orders that are executed only when certain price conditions are fulfilled. For example, if you believe that US dollars is about to go up, you can enter a limit buy order at a price above the market rate. If the rate reaches your limit price, a buy order is executed automatically. Then there are take profit orders, which automatically close an open position at a specified rate to lock in the profits. For example, if you're long US dollars, Japanese yen at 99, and set your take profit threshold at 100, your position will be closed the second it reaches 100, automatically. And finally, stop loss orders, which automatically close an open position to prevent further losses. It's basically the same as a take profit order, except you're capping your losses instead of your gains. And that's it. So, what do you say? Ready to make your first trade? Then get started today. Every day, roughly $4 trillion changes hands on the foreign exchange market. That's a lot of trading, but before you jump in, you need to understand how things are done on Forex. First and foremost, currencies on Forex are traded through pairs. Listed on the left is the base currency, on the right is the quote currency, in this case, euros and dollars. Then come two numbers, the bid price and the ask price. These are provided by a market maker or broker who handles the trade. The bid prices represents how much of the quote currency you would receive if you sold 1 unit of the base currency. The ask price represents how much of the quote currency is required to buy 1 unit of the base currency. The ask price tends to be slightly higher than the bid price, which is why most brokers only display the last 2 digits. The difference between the two numbers is called the spread, and that money generally goes to the broker as a fee. So in this case, if you sold 1 euro, you'd get 1.4112 US dollars. And if you bought 1 euro, you'd pay 1.4111 US dollars. Now, one term you'll hear a lot is pip. A pip measures the increase or decrease of a currency's value. 1 pip is equal to roughly $0.0001, depending on the currency being traded. Another set of terms is long position and short position. Taking a long position means that you've bought an amount of currency. Taking a short position means you've sold it. Now, how do you close a trade in Forex? First of all, just because you bought a certain amount of currency doesn't mean your trade is closed. In order to close a trade, or close a position as it's called, you need to buy or sell an equal amount of the open order, thereby reducing the open position to 0. For example, if you bought 1,000 euros, you are said to be long 1,000 euros. In order to close that trade, you must then sell 1,000 euros. It's only when you close a position that you actually realize the gains or losses of that trade, and either gain or lose that cash in your account. Positions that are still open at the end of the business day can be rolled over to the next day, in what's called a rollover swap, where the broker actually closes the position and then opens an identical position the next business day. So, those are the basics. Next, we're going to get you ready to make your first trade on Forex.